So many of you enjoyed my last video talking about my year-to-date performance, my best trades, and also my worst trades. And I did promise you that I'm going to explain my strategy around, finding such stocks like, for example, GEO, which more than doubled in around 8 to 10 months. Stocks like CoreCivic, which went up over 35% in 3 to 4 months. Stocks like Crocs, which more than doubled in less than 6 months. And many of those other stocks were just doing amazing while the Fed was talking hawkish and while the market was going down. You had many stocks that were actually making very big moves. And I did promise you that, and I'm going to deliver that in today's video. So again, I hope you enjoy it. Now, this is something I want to talk about. And this is something I get accused of all the time. I get accused of being a short-term thinker, a short-term trader, that I'm not thinking for the long term. It's like I committed a crime or something. There's such a cult around just buying a stock and holding it for the long term. Like this is the only way to generate any type of return in the stock market. Yet if you look at Warren Buffett's early days, whenever he was investing with less money than he had today. And this is a video they asked him, how can you get a 50% return on $1 million? And he said he can easily get a 50% return on $1 million. And he said he would not take the approach of buying high quality businesses and holding them for a long time. He would get a different approach of finding arbitrage opportunities and other misunderstood opportunities. And this is Warren Buffett's return when he was younger. He was generating up to 50%. Now, do you think if Warren Buffett was young again today, he would generate a 50% return by buying Amazon and dollar cost averaging in and holding it for 20 years? I don't think so. Do you think Warren Buffett would do it by buying Walgreens stock and collect a 6% dividend and then 3 to 4% appreciation and then make 50% by holding it for 10 years, or something like Smith & Wesson brand or some type of a dying company? Of course, Warren Buffett would not do it this way, and he explained it himself. So the big thing that people do is they copy what Warren Buffett is doing right now, where he can't really get in and out of stocks. Why? Because he has a lot of capital committed to them, 8 to 10% ownership in every single company. It's not as easy at his early days to actually take a profit. So whenever I'm taking a profit on something, or whenever I'm waiting to buy something, people say, no, this is timing the market. I'm like, no, it's not timing the market. This is what value investing is about. You buy it below fair value. As it approaches fair value, you sell it. But after Warren Buffett changed his investing of actually buying quality companies and holding them for the long term, and again, the main reason he did that because he can't get in and out of stocks because he has so much capital, people were just calling everyone who actually invests the old Warren Buffett way a short-term trader, a short-term investor. And again, I get those comments and I've never seen anything like this. So in this video, I decided to explain my strategy, which is not swing trading. It's not short-term investing. This is how value investing was before Warren Buffett actually switched his ways, finding, undervalued companies, buy them below fair value, sell them when it approaches fair value, and then find another type of opportunity. And I did give those examples in my video of talking about my performance with GEO, with high uncertainty situations like what happened with Crocs, what happened with CoreCivic. I highly encourage you to go back and watch this video. But I'm going to give you a couple of more examples in this video. This is a stock that I talked about before, and it's CSV Carriage Services, which they do own funeral home type of business, also cremation services, and a couple of other things. I talked about it before on the channel, and I'm not going to do deep research on any of those companies, but I'm going to give you an example of how I actually look at that stuff and how I actually do it. Now, whenever I'm looking for such stocks, I want to look for stocks trading at 52-week lows that are profitable. I'm sure you can go to any screener and try to find, look for 52-week lows, something that has, positive free cash flow, and you could start looking into those companies. And normally you don't find many of them because in a bull market, everything is at 52-week highs. So it's very easy to research them in a bull market. But in a bear market, a lot of stocks are at 52-week lows. So it's not very easy to actually research them. But this is CSV, and I talked about myself buying the stock around $32 per share. And this is a prime example of what can happen whenever you actually buy those things. Sometimes, you're catching a falling knife. The stock was trading around, $70 per share, and now you're buying it at 32. Sometimes you can get hurt doing that stuff. But again, this is why it's not as easy as just buying Amazon and holding it for 10 to 20 years. If you want 10 to 15% return, that's amazing. But if you want something more, you have to put a lot more work into actually doing that stuff. But again, I bought CSV at $32. The main reason I bought CSV at $32 was because the funeral home type of stocks were making a lot of money in 2020 and in 2021 because a lot of people were actually dying from COVID. And once COVID was starting, to go away and we had the vaccines and all that type of stuff, as you can see, the stock peaked around $68, $69 per share, and it started to go down. Now, my thesis was, and my research that I did a lot of research on this, and the research shows that whenever COVID death rates do normalize eventually, they're going to normalize above pre-COVID levels. In terms of the death rate is going to be higher than it was pre-COVID, and I'm not sure why, but this is what my studies were actually showing. All right. So this was my thesis on CSV. Whenever I enter such type of companies, I want to know why is the stock going down and what could change this trajectory and for the stock to actually realize the value. And when I was entering CSV, I knew that whenever death rates normalize and then things get back to normal and then they can, have more stability in their business, which what they had before, the stock is going to recover and then the value is going to be realized. Now, this is very different from buying Walgreens stock and holding it for 15 years. You don't know how the value is going to be realized and you don't know what's going to happen. All right. Now, I bought the stock at $32. Then it went down 28% in one day. And I remember that from $32 and it went down to around $22 per share. And of course, I started getting trolled on YouTube saying, you talked about the stock is down 28%. You don't know what you're talking about. It's just basic, retail investor behavior. But the main reason it went down so much is Q3, they really suffered a lot on the whole thing, comparing their income from Q3 of 2022 with Q3 of 2021, and Q3 is typically their lowest type of revenue quarter, mainly because there's no flu season, there's no winter or anything like that. Their peak type of revenue is in Q4 and in Q1. But in Q3 of 2021, they had a massive quarter. Why? Because people were dying from COVID. It was just the same type of quarter. So it was very stable. But now as COVID has gone away, which is actually a good thing for the population, there was nothing, no flu or anything in Q3 that could, cause a little bit more death rates than normal. So what happened with the whole thing, comparing those quarters, they look very, very bad. Total revenue is down, around 8%. Net income is down 55%. Operating activities cash on the GAAP basis is down around 29.7%. So it looked like an absolute disaster, and the stock went down again around 28%. Now, from me looking at this whole thing, and the CEO mentioned on the call that as they are going into October and November, they are seeing encouraging signs of actual, things getting better. As they suspended their guidance for the next, 4 quarters, which they gave a 4-quarter guidance, they suspended it. But on the latest 4-quarter guidance, they had $70 million of free cash flow. So I looked at the business, I said, all right, the death rate is eventually going to normalize as COVID is going away. When it does, if it settles above pre-COVID levels, 3 to 5 years from now, if they can just get back to $70 million of free cash flow, which is what they had in their guidance before this quarter that we had, if they just get back to $70 million of free cash flow, the stock is at least a double in 3 to 5 years. So again, I more than doubled my position and I bought in heavily when the stock went down 28%. Now after that, interestingly enough, the stock went up 21% in a matter of pretty much couple of weeks after. Now why did this happen? Because as the company was entering more into Q4, they saw a very encouraging number. They saw that the Q3 quarter was just a special case. They saw things getting much, much better. And they decided to do a lot of initiatives to get back to a free cash flow of 68 to 73 million, which is what I had in my type of numbers. And if they can get back to 70 million of free cash flow by 2024, this is their target. And if the company trades at 10 times free cash flow, this is another 90% upside in the next 1 to 2 years, basically, even maximum around 3 years from now, which is again something you can't get with Amazon. But this is a $400 million market cap. It's not a $1 trillion market cap. It does require a lot of research. And the company is doing a lot of initiatives to actually achieve this 68 to 73 million of free cash flow by divesting of funeral homes that are not performing well, by actually cutting expenses and cutting a lot of bonuses for employees and bonuses for executives until they actually achieve this type of level of 70 million of free cash flow. So this is my story with CSV. But again, you don't have to go and copy me on this, because I might decide to sell the position for a profit maybe tomorrow or maybe a week or two from now. I'm showing you those things so you can understand what I'm looking for, which is a high uncertainty type of situation. And from me looking at it and see what can cause the value to actually be realized, what can cause a change in sentiment in the underlying stock that I'm buying. And when I have all those things in mind, I open a small position and then I add to it and then I keep it. Again, you can look at another example, which is Charter Communications. And I talked about this stock in my video talking about why Michael Burry bought Charter Communications stock, and the stock was around $380 per share. Now, this is what I did with Charter. I said I would buy Charter around $300 per share. I'm not going to FOMO at $380, which is again very different from what people tell you on YouTube. They tell you, and again, they tell me in the comments that if I'm waiting for a specific price, I am trying to time the market. Of course, I'm not timing the market. This is my fair value. Why would I buy above my fair value? So again, I patiently waited and I put my price alert around $310 per share. And funny enough, a couple of days later, this got triggered and the stock crashed around 10 to 15% in a couple of days. Why? Because they actually increased their CapEx spending. Now, to me, that was not a big deal, as Charter has massive free cash flow and the management know what they are doing and they have a good track record. So I opened, again, a position around $305 per share, and now Charter is up 13% from my cost basis, which is only in a matter of 1 to 2 weeks. But this is the same thing in all those stocks. I look for high uncertainty situation. I look for a very ugly chart, a stock that no one wants to touch, that gets scared whenever they look at that chart. This is what I want. This is where I find such value. But those companies are not growth companies, so you don't hold them forever like you hold Amazon and Apple and Google and Microsoft and all that stuff. Those are companies in high uncertainty situations like what happened with the CapEx, which is stupid in my opinion. The market, of course, overreacted to this, all right? And I did buy a position. I'm up around 13% in a week and a half or 2 weeks. Now, because I'm not a greedy person, I might decide to take some profits even though Charter has not doubled yet. And this is something, again, that investors can't do. They want to get too greedy. They want to, get the full value, even though you can find a different stock which has a little bit better, upside potential, and, just hold it, or at least you can maybe, take some profits from what you had and not be greedy of making, 13% in a week or two, which is people take their entire year to actually make that stuff. Sometimes you get gifts from the stock market giving you your gains much earlier than expected. But people say, no, I'm not going to take them because I'm too greedy. I just want to, keep them to get a double or triple. And then you might not know what could happen with such, cigar butts type of companies. It could reverse and, go back tomorrow, which is why it's not as easy as actually buying, just a stock and just holding it forever. Now, this is another example, and this is, again, a very good example, and I haven't bought the stock yet. It's still on my watch list, and this is Lumen Technologies. Many of you actually know the stock. Now, this is one of the ugliest charts you will ever see in your life, because Lumen is trading at the same price that it traded at in 1988. The sentiment could not be worse around Lumen Technologies stock. Why is the sentiment so bad? They have a business in decline. they had a dividend, which people had it for the dividend. They decided to eliminate the entire dividend and focus a little bit more on buybacks. But their main focus is debt repayments. They want to pay back debt. Now, interestingly enough, Lumen actually got a new CEO. And this new CEO, she is focusing more on asset sales because they have a lot of valuable assets. They are trying to sell those assets and pay back the debt to take the interest expense off and actually, make the company a little bit better for shareholders where they can resume the dividend later on. This is the same thing as GEO, and you always have to have a good manager whenever you're buying such companies that no one pretty much wants to touch. And this is the recent initiatives to actually divest underperforming and high CapEx type of businesses that they have. They are focusing more on fiber because it has more growth for them. And again, this is total proceeds of around $12 billion. And they sold them at 11 times multiple, 5.5 times multiple, 9 times multiple, which is actually a premium of what they had on their own balance sheet. And the company does have a lot of debt, but it's now focusing on quick deleveraging. And their debt went down from $28 billion to $21 billion. And if this CEO, which she seemed very smart, she can keep changing the company around and actually prove to investors that now Lumen is a better growing company because of fiber. It's actually a less risky company because they are paying back the debt, and maybe they can reinstate the dividend later. Those are all massive catalysts for something like Lumen Technologies for the value to actually be realized, in my opinion. And the best thing with such companies, they have such bad sentiment that any kind of positive news, anything that's getting better, is really going to cause big moves to the upside with such stocks. But it can again cause also very negative moves to the downside with such companies, because maybe Lumen can just go down and just go to zero, which is why you should really know what you're talking about. But most importantly, you should actually, if things are not going well, if the management is messing it up, if something is not going right, if you feel something is not going right with the business or with their whole strategy, you have to exit the position, even though sometimes it could be, at a loss. Sometimes you just have to cut your loss and just move on to a different type of misunderstood type of opportunities. Because sometimes you get bitten by just buying such stocks that nobody wants, because maybe no one will ever want to touch those stocks again. But sometimes you could have a change in sentiment in your favor because you actually know why the stock went down, which is again the dividend investors selling, and then because Lumen is not growing and all the debt and all type of things, and the CEO is fixing that. Now, if she can successfully fixing that, Lumen can double in maybe 2 to 3 weeks. This is possible. But Lumen can also go down 10 to 20%, within a couple of weeks, which is why it's important to have the right position sizing. You have to be humble enough to accept that you're wrong and, just take your loss and be able to move on with such investment. Now, again, I explained this strategy today. It's not an easy strategy. It's not as easy as buying Amazon and holding forever. This is a much better way to make money, especially if you're a beginner. But if you actually know what you're doing and you're looking for higher type of returns, or for something like what Warren Buffett talked about, a 50% return. But it's very hard to get a 50% return by buying any type of a high moat, type of company and then holding it for another 10 to 15 years, unless, maybe you bought Tesla, which is a very rare occasion. But again, it's very hard to actually accomplish that. But if you're a beginner type of investor, I would encourage you to actually do that. And I also have such stocks myself that I believe in the 10 to 15 years down the road. And I'm actually holding those stocks, even though the return is not going to be 20, 30, 40% in a matter of months or in a matter of weeks. But I hope I also showed you the risks with such investments, as I had one, and it's Warner Brothers Discovery. It didn't work out well, and I made a mistake not selling the stock whenever I should have been, selling it. But again, this is my whole video for today, explaining my strategy. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.